Well, g'day there traders and friends, market participants and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you this pre-market update as we transition into Tuesday's trading session, that being the 21st of March 2017. Before we move into this analysis video, I would strongly encourage you to pause this current video if you haven't, of course, watched my latest market update. It's very important that you do so to really put in context this recent swing, this recent establishment of swing high resistance up and around 21,120 on the Dow Jones Industrial Average, and to really understand what is going on during this sideways market move. Obviously, the week just passed, or really the past trading session on Monday, it has been again the continuation of the stagnation in the market. We are continuing the sideways move. We were relatively weak. We closed down only 8 points on the daily candle yesterday, but again, it's looking as though we're going to set up this prolonged sideways move up and around this resistance area. We are looking for the continuation of Dow theory. We're looking for the Dow, the S&P, and the NASDAQ to break above the respective swing highs which we established at the beginning of March 2017. We've been, anticipating this market slowdown. The reason for that is because we have seen, again, the establishment of that resistance. We've seen a mixture of candlesticks aligned with some very important gap patterns which we're setting up. Again, whether or not this is a measuring gap or a continuation gap, whether or not it is some form of an exhaustion gap, the jury is still out, so to speak. But when you start looking at these oscillating indicators on different fractals, whether or not you're looking at it on the daily, the weekly, or the monthly, they are in essentially reset zone, especially on the daily chart, which is really what we look at in terms of the micro picture. You can see the Stokes is trying to turn up as at Monday. Again, it's sort of coinciding with the mixture of these candlesticks, which really aren't leading all that much confidence one direction or another at this particular juncture. You can see the RSI again trying to readjust, or at least move back down into more so of a neutral setting. It still hasn't really reset to the degree that we would like to look at before we see the next upward leg and the next upward push in this market. The MACD again above the RSI and the stochastics is most relevant and most important. You can see it is still strongly bearish. We are printing into negative territory on the histogram here, and this is really calling for, again, the continued sideways move. What does this mean in terms of the ADX and the CCI? Well, the ADX, if you go back and look at the past one, maybe two, if not three videos we were talking about, well, look what happens when the ADX turns down. We were looking for the trend to somewhat, to pause in the short term. It doesn't necessarily mean a termination of the current trend. Obviously, the trend to the upside is extremely strong, but really what it means is that when we get and push up into these historical highs, if you go back and look at this in context of where we generally see the ADX turn down, it is a very precise, very pertinent type of warning signal to at least realign your expectations with the forward-looking, expectations of market movements. That being, of course, again, that sort of digestion which we anticipated with price. And again, we're seeing that continue right through into Tuesday's trading session. The CCI is still printing healthy. It is still holding above 100, which is good for the bullish trend continuation. However, we're not calling for it over the next couple of trading sessions. We may see a pop back up into that resistance area, but again, it's very, very important for you to reconsider buying the dip at this particular point and trying to jumpstart, or at least jump on the trend a little bit before it really continues. What we're looking for, again, is for the Dow Jones, the S&P, and the NASDAQ to break above its respective swing high, which we established at the beginning of March, to close and continue above the respective swing high trigger points. We have the NASDAQ sitting very close to that swing high. You can see we've got a mixture of spinning tops and almost doji candlesticks over the past three trading sessions. It really is sitting on a knife's edge, so to speak. It may be the first market to break above that respective swing high, but please pay attention also to the Dow Jones Industrial Average and the S&P 500. You are, again, running, or at least anticipating, the breakout of this swing high point. If you jump in at this particular point, it's looking as though at this particular time that we are trying, at least, or at least market expectations and price action is trying to at least price in a lower high, which is relatively interesting given, of course, this particular gap here. Now, I've already mentioned two particular gaps, one being some form of measuring gap, otherwise known as a continuation gap. And again, if that is proven to be true, we would need to see these markets print above and continue above the respective swing highs. Then we can look back and say, well, or at least we can look back and try and find, projections as to how far price can move based on this particular gap showing up at this particular location. However, if we start to break down below some of these necklines, well, then we may have the potential for an intermediate pullback. And what I mean by that is that this potential material pullback, which a lot of people are simply not expecting at this particular time, really take a lot of people off guard. And if that is to be proven true, we need to see this market start to close below this 50 exponential moving average. Now, obviously, this is going to take some time, but we do have the warning signals. We've got the candlestick signals. We've got the oscillators showing us just how overextended we are in terms of momentum. And again, they are coupled into that reset zone. We've got multiple fractals of divergence happening across the board on these markets. Again, very similar to what we saw in the year 2016 before that really big pullback, which had us all very concerned about, in many ways, the structure of the market based on the technical picture. However, we simply aren't at that point at this particular time. There isn't all that much to be concerned about outside of the fact that we are potentially moving into some form of a stagnant range, given, again, the prolonged gains that we have printed in this market since the Trump presidency elect in early November 2016. The exponential moving averages are starting to flatten, which is somewhat interesting. They have been very, very strong, especially the 10 and the 20. But as you can see, they're starting to move, or at least align more so into a horizontal type of setting. Now, one further piece of analysis, very simply, again, is the top and lower Bollinger Band. It is starting to squeeze price. That means that volatility, obviously, at this particular time is suppressed. So we may set up some form of a Bollinger Band squeeze. However, given the strength of this underlying trend, we expect it to continue to the upside unless, of course, we start to see this 50 exponential moving average breakdown. And again, that is a long shot at this particular point. We'll have to obviously monitor the candlesticks and the price action up and around these highs, but it is somewhat cautious, or you should be somewhat, approaching the market in a sort of a cautious manner at this particular point until we break above the swing highs. Really, that's the name of the game at this particular point. It's best really to sit on your hands and to let the market prove to you that it wants to continue higher. If that is to be proven true, we are going to see a lot of individual trades triggered to the upside, but again, we are in some form of a pretty precarious type of situation across the board on the three widely followed US markets. Again, you can see that very similar type of setup on the S&P 500. You've got the swing high in early March, which still hasn't broken. We're seeing this pullback. This may turn out to be some form of a bull flag. We'll have to monitor that. There is the possibility and the chance of that. Again, generally what we see with bull flags is that when we align it with the exponential moving averages, oftentimes we'll pull back into the 10 or even we'll pull back into the 20. We'll see volume really dry up, and then we'll see a sudden long day Morobozu, bullish Morobozu, which will break out of that actual short-term consolidation and holding pattern. So we're still yet to see that. Volume is elevated 2 trading sessions ago. That was due to options expiration. So you can't really look into the volume, or at least dismiss this current potential continuation pattern being, of course, that bull flag at this particular time, because again, the volume is a little bit stretched and it is a little bit misleading if you're unaware of option expiration, which takes place during this particular time. So again, just to recap, we do have the NASDAQ sitting on a knife edge. It is very close to breaking out, but it is a very smart and definitely an intelligent thing to do, to really be looking for and at least waiting for markets in agreement. It is very important according to Dow theory, and again, it's one of the very important tenets of Dow theory. What I'd like to do also in this particular Tuesday morning briefing is just talk a little bit about the US dollar, because a lot of people are becoming concerned with the US dollar. It has been relatively flat over the past couple of months. The best way to really break this down for you is just to show you some of these trends which we have been in. So really since late 2014, the US dollar was more or less moving sideways. We broke out of this range and again we started to trend. This is on the weekly time frame. You can see these exponential moving averages which really supported price. We peaked just at around that psychological round number, around 100. We pulled back down and we started to set up this channel from 2015 through to 2016. And really, if you pay attention to this particular point, which is what I'll illustrate, on my chart right now, you can see that if you just look inside this rectangular sort of box that I'm drawing on my screen, you can see the natural wave oscillations. You can see the support and resistance holding. Although it isn't all that nice, you can definitely see that sort of long-term consolidation which has been happening in the US dollar throughout 2015 and 2016. It was roughly between 92 all the way up to that 100 area. Now, fast forward, or at least move to the more recent time, towards the end of 2016, we broke out above that very significant resistance area, which was coinciding around that psychological round number being 100. If I zoom out and break this down on the daily time frame, you can see that single inflection point over here. We broke out, we retested, we held old resistance as new support, and since then, although we have seen again the continuation of a little bit of volatility in terms of waves between resistance and support, we are still holding above this green box. And this green box is very, very important for, again, the continued intermediate and also macro health of the US dollar. although it is a little bit concerning to see the US dollar print in some form of a lower high, maybe on the intermediate term, it's very simple to address, I guess, the strength and potential weaknesses of the US dollar moving forward. If we use 2016 as a yardstick and the trend which is assumed to be in effect, given that we have multiple touches on this trend line, we can start saying to ourselves, if we extend this green box over, we really don't have to be concerned about any bearish or real true material bearishness, which we're sort of looking at on a macro picture until the US dollar really breaks below 99 on the index. Anything in this green box is very strong support, and we also couple it with this bullish trend extension, so we can sort of in many ways build some confluence between multiple areas of support, and we can essentially give ourselves some green box as to a likely turning point of what is otherwise known as a pivot point for the US dollar. It's very hard to actually predict whether or not it'll be here at about 134, or if it's going to be a little bit lower, even below, again, that psychological round number, which may really fake out a lot of sellers if we see a lot of buying pressure come in at this trend line extension. So this is a very important time for the US dollar. A lot of, I guess, the future gains, or I guess in many ways the appreciation or the depreciation in purchasing power of the US dollar is going to come down to this green box aligned with this trend line. If we start to break below this, well then of course we will see, and we should expect, some lower lows to be printed into the US dollar. But until we actually do that, you still need to, I guess, look at the US dollar rather constructively, and very simply to say to yourself that, look, this is support, and until this macro support breaks, we still need to look at this relatively favorably. Now again, we're seeing the oscillators reset. You can see what happens, and again, this is a very important sort of parallel between the US dollar and of course what's going on with the US markets at this particular time. You can see that we have been in reset mode. So you can see that the Stokes is crossing down, or it has been in a bearish alignment, coupled with the RSI, and the MACD is just printed into negative territory. Again, we're seeing those multiple bars in the bearish sort of vicinity, or at least in the negative vicinity of the histogram reading. This is all establishing again that the trend is slowing, or at least momentum is starting to slow. The ADX again is down at this reset zone. So really what happens now is that this can turn up bidirectionally. So it doesn't really matter whether we break bullish or break bearish. My assumption based on the technical picture is that we are going to hold at support, and this is, or in the meantime, in the short time, maybe towards the end of March, if not April, we are going to get a very sudden break to the upside. You can see also the CCI, it is relatively weak, but we are still holding above that very important macro support area. So again, there's not all that much to be concerned about with the US dollar. Again, there's a lot of buy the rumor and sell the fact, given the knee-jerk reaction to the Fed interest rate hike on Wednesday, again, raising it by another 25 basis points. You can see that this was more or less built into, I guess, the current market price of the US dollar prior to that Fed announcement. I think the Fed futures, or the funds rate, was sitting at about 96% certainty prior to the Fed actually giving the green light to raise rates. So there are a lot of people reading into this recent sell-off, especially the weakness on Wednesday and the continuation which we saw on Thursday, saying that this is some form of an inflection point or a turning point for the US dollar. I don't think it is the case, but of course, if the technical picture begins to break down, we will alter our outlook on the US dollar also. So I think that's all really that I wanted to say moving into Tuesday. I'm really looking at this quite closely. I am rather intrigued with this most recent price action. And again, really what you can take away from this in its core and its base is that this pivot point is key on the respective markets. It's coming in at about 21,120 on the Dow Jones Industrial Average. On the S&P 500, if I just bring up a new horizontal resistance line for you, it is around 20,400, which is roughly 35 or 25 points from where we're currently trading. We can easily get there in 1 day's worth of trading, and the NASDAQ is more or less closing at that same level. If not, it has closed above that recent swing point. So it is leading us to assume that we are going to see the Dow and the S&P over the next few trading sessions push on up into this pivot point. But what happens next is very, very important. Whether or not we see that exhaustion gap confirm, and that will be the turn down at this resistance point, or if we're going to see a legitimate breakout, which is going to flow through into a lot of the individual companies, which are going to set up very nicely for a lot of bullish opportunity moving forward. If you'd like to learn more about trading the US financial markets coupled with individual share analysis, I would encourage you to have a look at Pivot Point Pro. It's a class I do every Saturday. It is recorded and it is posted upline by Saturday morning for my US friends and also students and traders right around the world. Other than that, everyone, enjoy your Tuesday. Enjoy your week ahead, and I bless you, or at least I encourage you to Again, approach this market constructively, as neutrally as possible, and or at least try to not be misled by emotions. They are rather high at this particular point. Sentiment is rather stretched. And at the same time, momentum is starting to wane a little bit, but that doesn't necessarily mean that the trend itself needs to reverse. We are, however, moving into a little bit of a slowdown. That ushers in consolidation, and you need to be mindful of that and to sit back and look at this again very neutrally and to cherry pick the right opportunity to either enter into the market bullish. And I've given you, of course, the green light, or at least my green light as to what I'm looking for before I jump in. And also what we'll be looking for if the trend, or at least the chart patterns and the candlesticks develop in a certain way to really usher in sort of a more so bearish opportunity. If in fact the time merits it. At this particular point, it isn't, or at least it hasn't been justified, but I am, of course, keeping my eyes open to potential in the opposite direction as well, which is really, I guess, the majority of traders and also market participants at this particular point are rather blinded by, that potential doorway or that pathway which the market may take as we transition into April and also May 2017. All the best, everyone, right around the world. It is James signing off on behalf of Pivot Point Trading. Goodbye.